Okay, questions on any of three of those? So the catch with policy is that if Janet is trying to increase real GDP, then she'll tend to increase interest rates or decrease interest rates. If you're trying to increase real GDP, what is expansionary policy? To increase or decrease interest rates? Decrease, right? So we're going to lower interest rates, lower the cost of borrowing. Hopefully that'll help stimulate, get some people moving and thinking and new investments of capital. However, by doing something to increase this, we've done what with potentially this? It's gone up. So if we increase GDP or do some behavior to increase GDP, like decreasing the interest rates, we flood the money with market, or we flood the market with money, which raises inflation. And so the catch with a lot of these policies is that there's trade-offs. I don't have any magic bullet that makes all of these things move in the right direction many times. Sometimes, once in a while, there's a couple situations where that might happen. But otherwise, we're always looking at these trade-offs. All right. So with unemployment, that can come to us through fiscal policy or monetary policy. Fiscal policy, monetary policy. What do we got up in the fiscal side? Because we heard that word in those articles quite a bit too. Fiscal policy. Give me some examples. Zach, give me one. Fiscal policy as opposed to monetary policy. Timing. Yeah, it can. Timing could be important. Part of fiscal policy, thinking about it. But what are some general things? What are you timing? Like what types of actions? Who's doing fiscal policy, first of all? Obama or Janet? Barack or Janet? Dr. Yellen or President Obama? Who's doing fiscal policy? Sydney? Obama, good, yes. We had a 50-50 chance. Did you flip a coin or did you know that one?
I think I knew it.
All right, she thinks she knew it, good. So fiscal policy is Obama. So what kind of things, what kind of policy changes are in the Obama/Congress camp? I like to just say Obama, but it's really Obama Congress camp. Mr. Hooks. Tax rates, good. So fiscal policy, tax rates. Huge thing with Hillary and Trump thinking about tax rates. What else?
What about a stimulus package?
Stimulus package, what do you mean by that? So what are we doing? Because a stimulus package could be increasing or decreasing the tax rate. Would you call it a stimulus package or not? If it's an increase or decrease, which one's a stimulus package? A decrease or an increase in tax rates? Decrease, right? So the word stimulus could be a tax policy, right? But what's the other type of thing we could change to put some fiscal stimulus in action? What else could the government do? Paige. So they collect money here. What else is the government good at? They take money from people and then they just hold on to it? What do they do with it? What does the government do with their money? There's a big question. Reinvest it into society in what form? What do they do? What kind of things? Yes, you're right, so just keep going. What are they buying with their money?
Purchase.
Purchase what? Excess goods? Are they buying excess goods? What kind of goods are they buying? Alex?
Like bonds and stuff.
Bonds, possibly, yeah. So are they buying bonds? Just to pick on American companies.
Oh.
The Germans we talked about in those articles, the Germans might be buying bonds. They might be spending money on bonds. But what's the United States likely doing? They're selling those bonds, right? They're the ones that are collecting money. They're borrowing because their taxes aren't enough to cover their spending. Spending on what? What else? So bonds, U.S. government's not so good at spending money on bonds. Derek, what are they spending their money on? What's Obama and the gang spending all of our hard-earned tax dollars on? Education, sure. Military spending, national defense is the kick one. Do we build a wall? Do we blow up the radical people that are occupying in Syria right now? Do we just blow them to smithereens? You know, if we spend some money, where do we buy those bombs? We buy them from Guns R Us in the United States. If I go spend $100 million at Guns R Us pays their employees. Those employees go to Applebee's and have a steak dinner. That's the spending that's going on, right? So the government is just one of those places. Education, national defense, those are some of the key ones. The other key one is what? So this is kind of real goods and services potentially with education services and national defense. What was the other function that I don't want to leave off this fiscal policy? Subsidies, yes, and in general transfer payments. Transfers. Social Security, Medicaid, welfare, food stamps, and then other corporate subsidies for certain activities. We're taking in tax dollars and we're doing these primary activities. All right, so up here we've got the G and the T, tax rates, and these are all examples of G and G, C plus I plus G plus X. And these can be, the transfers can go the other way too. So, all right, so fiscal policy. Monetary policy. What was the thing? Into details, I'm not even going to go into it today, but we could rehash macro, but we will get into more specific tools of the Fed. But in general, what are they doing with monetary policy? Yes, and how to manipulate it, or how do they change it? Increase or decrease what, though? The discount rate, and then the required reserves and all of that, but in general, the supply of money, right? The quantity of money is under control of monetary policy. So really what we're focusing on here is the quantity of money, which we call the money supply curve with that last chapter. Money supply. And again, I don't want to get too much into discount rates or required reserves and all of that. But for right now, just think of them controlling the quantity of money. But it is important for you not to forget that this is currency plus deposit accounts. And we got into for this little illustration, I don't want to get into the M1, M2, and savings, small time deposit, but basically just deposit accounts, fairly liquid things. That's what makes up our monetary base and our money supply, is actual currency in circulation, not the currency that's being held in the bulk cash, but the currency that's out there in the general public, plus the amount of money that's held on account. All right, and so this is the Janet crew, and this is the Obama Congress crew, both of which are doing things that potentially impact this, and this, and this. And that's part of what we use our economic models for, is these two groups don't work together on this, per se. Obama doesn't have to go to Janet for a blessing on changing the tax rates. If you remember from macro, Janet does not have to go to Obama for a blessing on increasing the supply of money either. So both of these two act independently in trying to hopefully work towards these goals. All right, questions? So keep that in your notes, reference back to it. Hopefully you'll kind of start to just have this right off the top of your mind, because when we get into future articles and this class, I'd like to kind of rapid fire. In fact, I'm going to keep picking on you and ask, boom, what's at the top of your mind? And if marshmallows are at the top of your mind, you need more work. Fiscal policy, boom, Obama, Congress, tax spending, got it. Monetary policy, boom, quantity of money, Federal Reserve, Janet Yellen, that whole crew, got it. What are they messing around with that stuff? Hopefully they're thinking about these things that we all share in common. Hopefully, the general American public too would like to see low unemployment, low stable inflation, increasing real GDP. This is something we can all agree on, right? But the how and the what's and the trade-offs is where the tension lies. Okay, let's jump back in. Unless there's any comments or questions before I drop the curtain. It will be closed, but it can be reopened later if we need to. Okay, this is, I think we actually went on to the next slide. So this was bank profit maximizing behavior. So we're thinking about the bank being a business. The bank is this close to being a government entity. Let's just face it. With increasing regulation in the financial industry, the bank is this close to being a quasi-government entity. No, there's not a government representative that has an office in every bank. They come to visit often enough that they almost could have an office, right? So the government, this is the most highly regulated industry there is. I think it is in terms of maybe just depending on how we measure it. I was going to say the nuclear power plants are pretty heavily regulated as well. But I'd say, I would argue probably this is the most heavily regulated industry there is, the banking industry. One of the reasons is we all do it, right? Or most of us do it. If you don't directly have a bank account, then you are still impacted by it because the people you transact with have bank accounts. So it touches all of us. So that's why it's so important. Does it need to be as regulated as it is? That's where more free market economists might say the amount of government intervention is too heavy, causing us to lose small town banks, for instance. Maybe there's a benefit to having small town banks, and those are starting to disappear. Oh, why are they disappearing? Well, maybe it's because of the regulation. But if we value those small town banks and the things that they bring to the table, maybe the regulation went too far. I don't know. Those are just trying to stimulate some of the thinking that we do. So before we get too deep into it, this chapter is really covering a bank in detail. How do they maximize profits? What are some of the issues that they face? And so maybe let me back up a few slides to just go in the wrong direction. Just to kind of get your brains, there we go, this is on that. Remember, this was the average numbers for the banking business. This was a balance sheet showing a snapshot of the bank's assets and liabilities at a point. They've got money on hand, they own a few government securities. Most of their business is in making loans. They make loans at higher rates than they pay their depositors, right? So checking account deposits and other types of deposits are the bank's liabilities because it's your money, not theirs, right? So it's their liability, and your liability, your car loan and your house loan, is their asset because we're on opposite sides of the transaction, right? So just kind of remember that if you're confused about the balance sheet stuff, is to think the bank is opposite of me. My asset is their liability, and their liability or their asset is my liability. And this is roughly the types of proportions we see the average bank engaged in. Heavy into real estate. These would be like small business loans or other types of business loans, commercial and industrial, consumer loans, car loans, credit cards, etc. So that is the makeup for the most part of the bank. All right, questions on that or comments, anything you see? All right, so that's what we covered last time. Let me go back to the how. Okay, did we do this?
Yes. Yeah.
High capital, low capital. No, we didn't do this. We did something close to this, but. All right, so I can click this one, it's not that big of a deal here. Why would we need to maybe close the bank? So, low bank capital, high bank capital. So this is the amount of money that the owners have on. When they were short of required reserves, it's possible that they could go to the owners for money, was one way that they had it. And so here we're showing how banks can potentially fail. So what went on here? What was the changes that were done? Bank capital went negative, right? So bank capital, remember, stays fixed. 10 of us got together, we all kicked in $1 million, we have a $10 million bank. In general, the owner just sits there and does nothing, and the accountants recalculate the balance sheet depending on loans and deposits that were made, the normal course of business. But the $10 million capital was kind of fixed at the time. So as the bank fluctuates with reserves and loans, assets minus liabilities equals owner's equity, right? And so this is where it gets to be problematic. Is if we're negative, what does it mean to be insolvent? That's kind of a little upper division accounting type term, so it looks like a good one for Logan to tackle. Insolvent. You can just take your best guess. That's all I'm looking for. What does it mean to be insolvent? Something to do with basic assets and liabilities. Anybody want to jump in? Logan's passing. You have more liabilities than assets, that's all it is. And so if you had to settle up with your creditors, could you do it? If you had to settle up with your creditors today, could you sell all your assets and pay off all your debts? Answer, no, you're insolvent. You're insolvent. So if you liquidate all of your assets, you couldn't pay off your debts. What are the assets over here? Loans. Call in all my loans. Number one, that's not too realistic, but let's say we could call in all of our loans and get 85 million. What, by the way, what's realistic is when a bank's in trouble, if they've got $85 million worth of loans and they need cash right now, they can go to Wall Street or go to their other banker buddies and sell them, but it's going to be sold at a discount. $85 million face value of loans on the books. If you need to sell them today, like right now, I got to dump these babies right now. maybe you'll get 70 million. So it's even worse than probably what this is saying. If we had to have a fire sale, you probably wouldn't get that number. That would be through the course of a reasonable sale time frame. So we've got cash of 10 million, loans of 85. If I could liquidate them and turn that into cash, can I pay everybody's money back? No, I don't have enough to do it, right? So in a corporate situation, if that happens, what goes on? If you are insolvent, running a big business of some sort, what happens? If you are insolvent, and at this point today, if I had to liquidate everything, I could not sell it. Maybe not today. I don't mean fire sale with it. But if I got all my assets together, I wouldn't have enough to pay all my liabilities. Are they out of business? What's that? You're in debt. Yeah, you are in debt. You're still in debt. But because you're in a situation where the current value of your assets can't pay off those debts, do the doors automatically close for that corporation? No. So in other words, with a corporation, with a real world company, it's possible for you to, you're still insolvent, by the way, by the accounting definition. Your liabilities are greater than your assets, but it doesn't mean you close your doors. It's possible that you could ride it out. And in order to ride it out, what do you need to be doing for your loans? I'm back to the corporate idea. You have some debts. Your debtors will probably be okay with things as long as you're doing what? Making some money enough to pay them their monthly dues, right? So if you owe them $1,000 a month because of a debt that you have, they might not give a rip that this is true today. Long term, they should give a rip because they're like, oh, geez, am I ever going to get my money back? Well, as long as they're making their monthly payments, I don't care, right? So if they're able to service their debt, it's possible to be insolvent. That's something that you can ride out. If we don't have enough money from operations to pay for our minimum payments, if you will, on our liabilities, we are illiquid. If you don't have enough money on a personal finance level, this is the situation where you get paid $2,000 a month and you've got $2,200 worth of bills every month. You are illiquid. Somebody's not going to get paid, right? You can't squeeze blood from a turnip. You've got $2,000 worth of money, of income. You've got $2,200 worth of bills. All right, now at that point, if you are insolvent and illiquid, what do a lot of personal people, households, and businesses do? Declare bankruptcy. So bankruptcy is a legal action where you're seeking protection. A lot of times there's misperceptions on what bankruptcy is. And somebody might say, oh, I'm insolvent. I guess I'm just bankrupt. There's no way I could sell everything and make do. No, you're not bankrupt until you've actually gone to the U.S. government for protection and declared you are bankrupt. That's when you're really bankrupt. Oftentimes people are insolvent, but they can possibly ride this out and never declare bankruptcy, right? Same thing with illiquid. You might be able to talk to your creditor and say, hey, times are tough. I've only got $2,000 this month. Is it okay if we let that $200 ride for next month? Oh, sure, you've been good in the past, no problem. So you can ride out your illiquidness, possibly, in the short term and make amends with it. But eventually, that's not sustainable. And so if you, for a long period of time, remain insolvent and illiquid, you are bankrupt. By the way, it's possible for you to be solvent and illiquid and declare bankruptcy. So it's possible for you to have, let me give you an example. if I've got $1 million in real estate and 1.99, what am I trying to do? Yeah, 1.9 million in, if I've got this in assets and this in liabilities, I have 100,000 to the good. I am solvent, right? My assets are greater than my liabilities. I'm solvent. But if I don't have enough money to make all my payments for these liabilities because my business operation's bad, I've got a $2 million building that I don't have any debts against it or something. I have assets of $2 million. I've got machines and stuff, but I can't make my payments. I might be illiquid. I can't make my monthly payments, and now my creditors are saying, hey, you got to pay me, you got to pay me, you got to pay me. It ultimately forced me into bankruptcy. And if I have, after I sell all these assets, after late fees and penalties and other things, if I have $120,000 worth of debt, they're going to take this 100,000 and they're going to spread it evenly over all the people that I owed money. But everybody's going to get equally shorted according to the amount of their debt. All right, so I probably spent too much time on that, but hopefully that frames up some things here. The government regulates things so that that don't happen as much as they can. And they will bail out, they will bail you out. They're really bailing out the depositors through the FDIC insurance. So our FDIC insurance is going to protect these guys, and that will potentially force a bank into bankruptcy. Some of those owners might still stay on the hook for the amount of the bailout. Otherwise, it's generally kind of settled out. So that gets in a little bit deeper, but they're going to monitor so that this doesn't happen, and hopefully they have reserve ratios that are maintaining a healthy amount of capital in the bank. Okay, I threw a lot at you. What you got for questions? Yes?
Assets and liabilities are equal, is that still solvent or
Still solvent, yes. So if assets and liabilities equal each other, you're still solvent. But if this is 0, that's not high enough for the government. So for the Federal Reserve, they're going to require this to be greater than 0 at some amount. That's part of their policies that they do. They're going to say, you have to maintain bank capital at X amount. Okay? Anything else? Financial administration. It's got some words of wisdom here from Dr. Moore's class. Capital adequacy management, returns to equity holders. So equity holders are the owners of the bank. We've got return on assets, net profit after taxes divided by the value of your assets. So you've got the balance sheet items that are your assets, and then we take your operating flows to see what that ratio is. Okay, so that's one statistic. Let me give you an example of how that would be. I think I actually gave this to you before. If I buy a $100,000 duplex, I own an asset of a duplex, I pay cash for it. From that cash, from the ownership of that, I have renters and expenses. And ultimately, I end up having a net profit after taxes of $10,000. What is my return on assets? If I've got $10,000 net profit after taxes and I buy a $100,000 duplex, 10%. So 10% return on assets would be how we calculate that. Return on equity, we're going to take that same $10,000, but now divide it by my equity capital. how is that different than your assets? The equity. What does that take into account that the top one did not? Let's see, Mitch, haven't heard from you yet. Equity. Kind of the main question here is, how does equity differ from assets? What's the relationship? Basic accounting, give me your shot, give me your best.
Assets are stuff that you own.
Yep.
And then equity could be stuff like stockholder or stock shares and stuff like that.
Okay, so it's your ownership. So what's the connection with liabilities then?
Then
What's the basic equation there with assets and equity, owner's equity, if you will, or whatever, bank capital? Assets equal liabilities plus owner's equity, or assets minus liabilities equals equity, right? So assets minus liabilities equals equity. So now with my duplex example, remember I told you I paid cash? What if instead I got a loan for the duplex for $80,000, right? So if I got a loan for $80,000 on a $100,000 duplex, I put $20,000 of my own money up for it, right? So the asset is a $100,000 duplex minus the liability of the $80,000 loan gives me $20,000 worth of equity. From an investment standpoint, I put in $20,000 of my hard-earned cash, and now I look at the returns on the duplex. The net profit after tax now includes some interest probably. So if we put apples to apples, my $10,000 number up here might now become $10,500 or $10,000, $1,100 or more than that, right? But there's some sort of interest factor. So my net profit after taxes based on the equity that I have in is this number divided by the 20,000. All right, so the relationship between ROA and ROE is expressed by this equity multiplier. All right, so what's the three-way combo? See the three-way combo, question mark. Equity multiplier. What's the connection here? What's our common between these two? We got the profit after taxes, right? So something's going on with that. Net profit after taxes, net profit, assets over equity, return on equity equals the equity multiplier times that. So the equity multiplier is just your ratio of your assets to your equity. All right. Benefits, cost. What's better? What's better? Capital adequacy, having enough capital, having a fat enough number there when we kind of think about the equity relative to these other issues. Why is there a lower return when we have more capital, more equity? Why is there a lower return? We talked about that last Monday when we covered this. Lower return. If you have a fatter capital number, why is there a lower return? Chisholm.
Well, I'm looking at the.
Okay, the ratios.
Yeah, those. And the equity.
Okay, so Chisholm's taking the completely mathematical approach, which is absolutely true. If you look at those ratios we just did, fatter capital ratio is in the denominator, makes the whole expression get smaller. So from a purely mathematical standpoint, you're absolutely spot on. What about from a conceptual standpoint? If you're sitting on more capital, what aren't you doing with it? You're not loaning it out, right? And loaning it out is where you get the returns potentially. So that is our trade-off that we face. And that's going to depend on the owners in the boardroom, what they vote on, if they want to play it safe. If they think that the economy is going to take a crap, then, and what happens when the economy takes a crap in terms of their loan portfolio? If the economy is taking a crap, what happens to their loan outstanding? Depreciating value, that's one, you're touching on the right topic, maybe not saying quite the right word. I'm not worried about depreciation, but the riskier. So it's in what sense? What aren't the people going to do? Default. It's the default risk, right? So when the economy goes down, defaults go up. So there's higher default risk, right? And so the value of those things goes down. And if all of your money's loaned out, then you're not going to be able to ride out the storm very well. So this is really a trade-off here. The benefit is that you feel safer. When you have that big cushion of cash, same thing with personal finance, by the way. When you have your emergency fund, 3 to 6 month emergency fund saved up, right? When you've got that big cushion of cash, when the economy hits the crapper and you lose your job for 2 to 3 months, you just ride it out, baby. You just start drawing from your emergency fund. You can still pay your house. You can still pay for your car. You will get your kid through school. You can ride out the storm. Same thing goes with companies and fluctuations in the economy and in the banking industry. All right, we'll call it a day there. Have a good weekend.